we detected an unusual trade worth $2.3 million in Target stock on the last trading day. And what's also very unusual about this trade is that Target reports earnings in a few days on May 22nd. So in this video, we will analyze this unusual option activity to find out how this wealthy investor is trading Target for earnings. Are they bullish or bearish? And then show how we set up a trading strategy in the same direction as this $2.3 million trade. Because as we all know, the rich have more access to information, including insider information, such as earnings reports, to make better financial decisions on Wall Street. No wonder the rich get richer. So without further ado, let's dive into the data as usual. As we can see on the options time and sales tape, the biggest trade on May 17 were these May 31st options at the 155 strike calls. 2,568 contracts were being traded. They paid $900 for each one because we have to multiply by 100 to get the total cost, because each option represents 100 shares of stock. And so the total trade cost is 900 times the number of contracts, 2,568, which equals $2.3 million on this trade. So is this bullish or bearish? And are these trades closing out of a previous trade? Because if they are not opening a new trade, then this data is actually the opposite direction as to what we have here. Okay, because if they're closing out of their trades, we may not necessarily want to follow that because we don't have an existing trade already. Unless we already had one, that may help us, which is what we do to make some of our decisions when we trade. But let's take a look for the May 31st options. These unusual options here at the 155 strike calls. We can see 2,800 contracts, the volume being traded, greater than the open interest of just 68. So we know these are opening trades. So that we can also open a trade based on this data. And as we analyze the variables on this trade and also the market data, we found that these 155 strike calls were being bought to open for $900 each. And so when we analyze this trade, you can see here that the price of target shares on the x-axis here, profit loss on the y-axis. So as the share price of target goes up, these options become profitable. And as it goes down, they become a loss, a negative here. So we know these are bullish long trades. We can also see from the delta here, has a positive delta. So that's a bullish trade. If it was a bearish short trade, it would be a negative delta. Now keep in mind, you can see here, the theta is a negative 23. It's a very high time decay risk here. Another risk here is vega, a positive 11 vega. That's also an additional risk because we have earnings coming up. And after earnings, vega will go down, volatility. And so this is not favorable for an earnings trade. And that's why we set up our own options strategies based on this data. We don't simply just follow the unusual options because we want to increase our chance of profit, because this trade already is a lower chance of profit trade in comparison to the ones that we share on our website, because there is earnings event coming up. That's a binary event, okay, where it will either go up or down. And so if you are interested in the higher chance of profit trades that we share on our website. I'll put a link up here where you can gain access to the trades of wealthy investors that have a much higher chance of profit in comparison to this trade. Okay. So how did we set up our earning strategy based on this? Well, for one, we will also be going bullish long, but we did not buy these call options. What we did for earnings is we went to a shorter date, May 24th, expires just 2 days after earnings, May 22nd. And you can see here our position over here for 3 different options over here at the 167 and the 172.5 and the 175. So we sold the 172.5 strike calls for each of our trades. We sold 2. And then we bought the 167.5 strike call and the 175 strike call. So each of our trades, when we analyze it, you can see cost $97 each. This is the ratio of our trades for this butterfly strategy, and we can use position sizing to decide how much we want to risk here. But for demonstration purposes, we always set everything at 1 trade to show more clearly what we are doing. You can see here, target at 160. As the price goes down, it is a loss. If it goes up, it is a gain. But notice max profit, if we trade around 172.5, you can see the blue line, $400 showing up at max profit over here. Okay, so that is our max profit on this trade at this $400 price here. And you can see that this essentially means we can make 400% on this trade. Okay, because we have a 1-to-4 risk to reward ratio here. If it rallies even more, we can still make more than 100% because you can see the max profit is 153. That's greater than the cost of 97. Okay, so the reason why we prefer this as an earnings trade is specifically the option Greeks. As we explained earlier, the Vega is very important. We don't want a very positive Vega. And you can see here, this Vega is nearly 0 at 0.69. So the volatility crush that happens after earnings will not affect this trade very much. Okay, so that is why we prefer this strategy for earnings. We always want to make sure we can increase our chance of profit by setting up options strategies that are in our favor. Okay. If you want to learn more about our strategies and how we find the higher chance of profit trades by analyzing the wealthy investors and the insiders, what they're doing, the stocks that they are picking, make sure to go to our website. We'll put a link at the top here. Let us know in the comments below. What do you think will happen to Target for earnings? Will it go up or will it go down? As usual, please smash the like button, subscribe if you haven't, and have a great weekend. Take care.